A half century of Wall Street survival. A diary of a retail investor by Dr. M.S.PATIL.M.D. from the very heart of Chicago's financial district, USA, July 2026. In early 1976, I commenced investing my money in the US stock market. This occurred when the Dow Jones Industrial Average had reached 1,000 once more, following a substantial bear market that has resulted in a 50% decline. As a typical retail investor, I made my investments following the news that had gained widespread attention in general interest newspapers and was broadcast on television. Today, the same Dow Jones Industrial closed around 53,000, that is 53 times more than when I started. Since 1976, the broader US market has experienced seven major bear markets driven by events like stagflation, the tech bubble burst, the 2008 financial crisis, and the 2022 rate hikes. Volcker-led Federal Reserve tightening in 1980 to 82, 1987 Black Monday crash, 2000 to 2002 dot-com bubble, 2007 to 2009 Great Recession, 2020 COVID-19 pandemic, and 2022 inflation and rate hikes were all to blame. Throughout the periods of market downturns, I mostly adopted a patient approach, refraining from panic selling until the markets rebounded months or even years later. While I listened to various market gurus, I have ultimately learned to make my own investment decisions over the decades. Remarkably, I have survived to share this experience after half a century. This demonstrates that retail investors, even without investment advisors who educate themselves about money, markets, and human psychology, can indeed survive to match the professional investors, even though inflation battle can humble you. If I am between the ages of 30 and 70, I would allocate an equal amount of money to 8 to 12 different, broadly diversified, high quality, low cost, no loads, stock, bond, index mutual funds, or similar ETFs, as well as money market or 3 to 7 year short treasury funds or notes. I would hold these through both bear and bull markets, until I am at least 70 to 79 years old. I would control my emotions of greed and fear and maintain composure. Growing my money shall remain as my primary goal. The stock market fluctuates daily. I invest money that I do not require for a minimum of 5 to 10 years or longer. The power of compounding helps me in the long run. While the market does not guarantee a swift profit, it is generally worthwhile for individuals with a long term goal of 5 to 10 years or more. A recent Morningstar research article states that forecasting the duration of a stock market decline is hard to predict. By refraining from panicking and selling investments during market crashes, investors can potentially achieve long term gains. The frequency of market crashes and declines serves as a reminder of the significance of patience in equity market investing. During periods of rapid and significant declines, it is imperative to avoid panic selling. If I am 80 years or older, I would refrain from stock market or have experts manage my money. The majority of my assets would be diversified across various assets, including short-term 2 to 7 year US Treasuries, money market funds, bank CDs, my modest personal home if I already own one. Preserving the capital and staying liquid are the sole goals. Today, as of July 8, the S&P 500 stock index concluded at 7,483 on New York Stock Exchange. Presently, US stock market is valued at US 75 trillion, while the US GDP stands at US 32 trillion. The overvalued Warren Buffett indicator is signifying that the US stock market is in overvalued territory. The Kapor-Shiller PE ratio stands sky high. This ratio has been higher than this only once during the dot-com bubble of the early 2000s in last 150 years history. It is imperative to acknowledge that no single indicator can be regarded as infallible. Conversely, S&P 500 forecast for the year 2026 ranges from 7,100 to 8,250. Goldman Sachs research recently anticipates that the valuation multiple of our US stocks will remain stable at 21 times earnings. As a retail investor, it's crucial to discern which of these forecasts hold the most credibility. The US has intermittently borrowed and printed money for an extended period. Consequently, the US Treasury issues, the stock markets, and the US dollar may lose their reputation as a safe haven and depreciate in value within the next 20 to 30 years. Despite the above facts and my cynical outlook, I am inclined to posit that the US will continue to be one of the global superpowers for the next 20 to 30 years. Summary: I have consistently emphasized the importance of patience, broad diversification, simplicity, ongoing financial education, and controlling emotions such as greed and fear. My investment approach involves holding a diversified portfolio of low cost, no load index mutual funds, liquid assets like money market funds, and short term US Treasury notes. I generally avoid individual common stocks but occasionally hold them for educational purposes. Complex investment vehicles such as options market and margin buying are not part of my strategy. Evaluating my performance over the past half a century, I would grade myself B plus to A minus. But after accounting for inflation, I would adjust it to B minus. Although my returns may not be exceptional, I take satisfaction in having survived the Wall Street warfare for past half a century through conservative investing. Today I am pleased to have achieved a middle class status. Thank you. Please see. I have no conflicts of interest. I am neither a financial consultant nor have I received formal education in finance and investing ever. I speak solely from my personal experiences. Please consult your financial advisor if necessary. Please invest your own money at your own risk. ChatGPT has assisted me in enhancing my English writing proficiency. Thank you. Written, edited, narrated, and produced by Dr. M.S.PATIL.M.D. from the very heart of Chicago's financial district, USA, July 2026. Thank you kindly.